All right, I guess we are live here. I'm just gonna see, where is it here? It takes a second to start. Do, 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 do. All right, we're gonna go live here in a minute. We're just checking, make sure people are on. You can hear me all right, Dave?
Hear you great.
Okay, perfect. So, yeah, I figured we were talking a couple of days ago about just the market situation, how real estate's changing, how we experienced some great value in the beginning of the year, and we've been doing this. Um, we've been working together for some time now, and we've experienced all sorts of different markets over the last, I would say, 5, 7, 10 years. But your experience goes back a lot further than that. For people who don't know David Thompson, 35 years as a real estate agent. A couple of things reasons why you should listen to him. Remax Lifetime Achievement Award. This is held by less than 5% of the Remax agents worldwide. Here locally in the city, he's a Medallion Award winner for the last 30 years in a row, which is held by about the top 10% of real estate agents in the city. And, we talk a lot about real estate agents and what it takes to be in the top, to be in that top 10%. We'll get into a lot of that in a minute, but I guess the first question is, before real estate, um, what were you involved in? I know a little bit, but let's tell the people at home why real estate? Why did you get into real estate, and what did you do before real estate?
What I did before real estate was I was a retailer. I was a part owner of a couple of Roots stores. Roots was a leather goods company out of Toronto, and that had definitely helped me because in my early 20s, by the time things were up and rolling, I had maybe 50 or 60 employees, and running a small business. So that experience helped me. Why I got into real estate was the retail climate in Winnipeg took a significant downturn. My mother-in-law was a realtor, so she said, "Why don't you try it?"
Mm-hmm.
And I thought, well, I'll try it for a year, and here I am, 35 years later.
And so, just to touch on the retail industry went down in Winnipeg. What year was that, and why do you think that was?
It was the late 1980s.
Mm-hmm.
Um, why it went down? Maybe just the tail end of a recession. Um, a fair amount of factors, but I had the ability to get out of the business and then start a new business in the real estate industry, which I knew very little about,
Mm-hmm.
but I thought I would give it a try. And like I said, I thought I would try, see how the first year went, and then I would keep going if it worked. And so here I am.
So, one question I think I think it's important to ask is, why should people listen to David Thompson?
Well, of course you can listen or you cannot listen, but
Yeah.
I've been immersed in this for 3.5 decades, almost every single day. So I've seen markets. You know, the definition of a market, whether it's the real estate market or the gold market or any market, is markets go up and down, and so that's not necessarily a bad thing. It's people that are looking to get into that market, whatever that is, become aware of what's happening with the market, and B, how can they best leverage that for their own gain.
Mm-hmm.
So I guess the main thing, other than being involved in thousands of transactions and seeing things, how things go one way or the other, is that I have had the opportunity to see many market shifts. And equally as important for the people that are the people that you work with, I have seen people take advantage of market shifts because they have not been afraid to act.
Yeah, and that's really important. So, next question I kind of have for you is, what what do people misunderstand the most about the real estate market today? Like, what's happening?
I, I would say that uh, the most misunderstood thing is that people need to realize that real estate markets are very localized, which means if you're sitting home late at night and watching the CTV news, or you're on the Globe and Mail website reading the latest post from the Globe and Mail,
Hmm.
most of the information as it relates to the real estate industry, the real estate markets on those mediums are going to be directed to like Vancouver, Toronto. Definitely we've experienced a bit of a slowdown here, but we're not like those markets. In fact, I sent you a chart that I created a couple of weeks ago showing the average sale price in Winnipeg since 1977. I told you that I wanted to go back to 1945, the end of World War II. I haven't found those stats yet, but I've been able to find stats for the last 45 years. And what that chart shows is that in the last 45 years,
Hmm.
we have seen price appreciation every single year over 45 years, except for 2 years in the early 90s when the market dropped by about 1%. So to see no price declines in a 45-year period, except for 2 years out of 45, and those declines were incredibly minimal, I think that scientifically, I guess, shows what the market is like in Winnipeg.
Yeah, we've got to really, you really have to take a look at the economy that the market is in, because Winnipeg has a very diverse economy, and you can look at your market. There's vanity markets, there's value markets, and when things take a crash, it's typically vanity markets where the price was inflated irregularly, speculation and investors pumping the tires on the marketplace. But at the end of the day, the bricks and sticks are worth X amount of dollars always, and that's really what it comes down to, right?
100%. You know what I've always felt, and the statistics prove it. Winnipeg is a very stable, very safe market. Some people may call it boring. We certainly don't have appreciation like Toronto or Vancouver, where prices can go up 200,000 overnight. But by the same token, they don't go down 200,000 overnight.
Yeah. So if you're speculating in those marketplaces, you got to be paying attention to the volatility. But if you're looking to invest, it's like you said, it's a boring market is one that is definitely one where you can put your money in a safe position, because boring is safe, and if people could put their money in positions that are boring, and it might not be something to brag about, like if you did something maybe in Toronto or Vancouver where you have some windfall, but ultimately your money isn't going to evaporate overnight like we're seeing with Vancouver and BC now. um, that being said, in your opinion, is there opportunity in those markets when that vanity evaporates?
Yes, because markets, like I said before, they go up and down. So even those markets, of course, those are two, arguably the most desirable cities for people to live in. When we have immigration, there's a lot of immigration to those markets, which drives things up. Uh, so yeah, I think there's opportunity in those markets too, for sure, because yes, they have gone down, but they'll eventually go back up in the not too distant future.
Yeah, probably 12, 18 months, you're going to see it bouncing back. So, interesting question. If you could go back to your 18-year-old self, what's one piece of advice that you'd give yourself?
Um, I would, well, the two pieces of advice, I guess, would be one, I would not hesitate to spend money on educating myself. I started training with a guy, I told you about Craig Proctor,
Hmm.
but I only started with training under Craig, after maybe 10 years as a realtor. I would have liked to have known him earlier and started, because any money that I invested in training uh, has come back to me 10 times.
Yeah.
So that would be number one. And the second thing would be to start investing in real estate. Those would be the two things that I would recommend. Don't be afraid to spend on education and training, because if you find valuable education and training and you implement it, which is the key, you've got to
Yeah.
implement it. Uh, that money, that it's not a spending of money; it's an investment, because the investment will, in my opinion, in most cases, pay you back at least 10 times. And the second thing is, I would, I wish I had bought, 10 duplexes over my life, and 10 great duplexes, and just sat on them.
Yeah, and this kind of leads to the next question. Why do you think it's important now more than ever for people to learn to raise money and start buying real estate?
Because number one, in the current market that we're in right now, there's an opportunity to buy when the market has cooled a little bit, because the market will not stay cool forever.
Mm-hmm.
And the second thing is, we're in the middle of a very large generational shift of wealth, where people that are in their 50s and 60s, who have elderly parents and are, in the near future, are going to be, you know, for lack of a better scenario, inheriting some money. We're Because of this generational wealth shift, there's people sitting around that have money, and some of them will be willing investors, especially, if you want to, let's say, flip properties, and you go to an investor with a proper business plan and say, I need money to flip this property, and it's a 4 to 5 month turnaround,
Mm-hmm.
and I'll pay you X. And the X, of course, is going to be much better than they can do in the bank, and the risk is almost zero. So that's why I think it's a good time to start raising capital, like today.
Yeah, and that's one of those skills, like I always say, they don't really teach you much about finances in school, and they certainly aren't teaching you how to raise capital. It's kind of a secret where wealthy people are using other people's money to scale their business. Like, you can't save your way into buying 10 properties this year. It's not going to happen, especially with the price of consumer goods. Like, we're getting killed at the pumps, we're getting killed at the gas station, and that's fine. We have our consumer spending, but there's people, like you're saying, with RRSPs and all sorts of savings accounts, and this generational wealth shift that are looking for people who are in tune with the real estate market, who are trained to invest for them so that they can take advantage of this window that I see. It's probably looking at maybe a 12 to 18 month window before the correction starts to subside and speculation returns and construction returns. And one big thing that I'm reading about, and maybe you can comment on this a little bit, is with the interest rates rising, you're seeing developments being canceled. They're not building these skyscraping condos, and builders are pulling back, which is going to be, in my opinion, I think is going to really push the existing inventory up, because they're not making any more, they're not making enough property fast enough to correct the supply and demand. So if you're able to get your hands on stuff, you're going to experience the natural inflation of the supply and demand. This isn't like Bitcoin or the stock market where it's being manipulated. These are houses and people and rents. I just watched a video. Rents are up 36% in the last 12 months. So cash flows returning, and with this, I guess the question is supply and demand. Where do you see the supply and demand going in Canadian real estate across the country?
Well, I think the government announced a plan to invest a lot of money to help build more properties. All of these other mechanisms that the government has tried to put in place, about stress tests on mortgages, limiting the amount of commercial mortgages until you have to go to a commercial lender. I mean, I think they're well-meaning, but like a lot of things the government does, they're not, in my opinion, the appropriate actions. The number one issue in Canada, for sure in Winnipeg, but all across Canada, is lack of supply.
Mm-hmm.
supply. So while I have said earlier that the market in Winnipeg, as an example, has cooled, if you have a nice property in a nice location that is reasonably priced, and strongly marketed, there'll still be five people that'll be fighting over it,
Mm-hmm.
because people still need to live somewhere, and we still have a supply problem. And until the supply problem is cured, which it may never be, that's always going to keep driving up the price.
So, as an expert, I've been working with you for like I said, most of my career, and I consider you an expert at identifying value unseen by other realtors and other investors. Um, you know, why do you like to work with buyers who have raised capital to invest versus other types of buyers?
Well, typically the buyers that have raised capital are quite serious about making a decision, and I like to build long-term relationships. So, for example, if somebody says I would like to buy a duplex and I would like to hold it,
Mm-hmm.
if I renovate it, will I be able to get an appraisal of X? So I like to provide them with quality information so that in most cases that comes to be. If somebody says, David, I'd like to get into flipping, can you provide me with, an as accurate as possible ARV after repair value? Again, I try to provide an accurate ARV so that they make money. So these are people that are very serious about doing something, and I like to build relationships by providing them with good information so that they make money.
So if you have a property, because you're getting leads all the time on different foreclosures and properties like that, and you have your choice between someone who is going to get a mortgage and having to qualify and all this versus someone who's ready to go, who's the first call?
The ready to go investor.
Yeah, I mean it's kind of obvious. I set the question up that way, but the
Yep.
the reality is like, and that's really where the deals are coming from. Is real estate agents are going to be funneling the money um, from these investors versus calling XYZ, who have to then get an inspection and a mortgage qualification, and there's inspections and things like that. But to have the money ready to go, especially now in this window and building that war chest. I was on a call with one of my investors yesterday, and he's like, I'm ready to put 250,000 in Winnipeg, and if it goes well, I'm ready to bring 250 million to Winnipeg. And this is the reality that's not on CBC and CTV. Is the true investors understand the market dynamics and they're ready to invest because they've been around through the ups and downs. Now, tell me about tell me about the last time it was. Um, we had a recession. I think it was like in the 80s, probably bleeding over into the 90s. Um, how long did that last, and what kind of strategies were you guys implementing as like you were just starting at that point, but what were you doing to be successful in a market such as today? And if there's a time that you remember that's similar that you could speak to.
Well, first of all, it didn't last very long. From what I remember, it probably in that early 90s period, it probably changed after maybe a year or 18 months, like you had said earlier. Um, the strategies that I implemented then, I mean, I have to think back, but probably the biggest strategies I implemented was to find sellers who were willing to offer attractive financing. What I mean by that is, if you had a home that you were trying to sell that had a 14% first mortgage, which existed in the early 90s,
Yeah.
uh, I discussed with the sellers uh, doing what's called a buy down, where they agreed to pay the lender a certain amount of money on closing when they sold, so that the new owner could take over their mortgage, and instead of at 14, it was at like 10 or 11.
Right. So
So
like every
creative
dollar.
financing,
Yeah, creative
creative
financing.
financing.
Do you see that that's a strategy that's going to start emerging in the next 12 months, or have the regulations kind of changed around that?
No, I think that, I mean, and nobody knows. what's going to happen in the future, but I don't see rates going anywhere near there. I mean, even with whatever the current 5-year closed mortgage rate is today, and I haven't checked, it's still incredibly low. Historically, it's still an incredibly low rate. People may be freaking out because, prime was like at zero for a while,
Mm-hmm.
but if you can get a 5-year mortgage, if you're like a young couple buying a house and your 5 years locked in at 4.5 or 5%, that's still, in the historical context, that's still an incredibly low rate.
Yeah, it's I find it challenging to explain that to people who've been in the market for a year or two, because they came in at a position in the marketplace that historically we hadn't really seen, and now people are shell shocked a little bit by the fact that it's raising back to a more normal position. Because I can remember, back in the day, when I started 2015, interest rates were probably 4 or 5%. Um, would you recommend people buy more expensive properties when they're investing right now, or with that interest rate, would you recommend that they buy cheaper properties like below the margin, or where's the sweet spot in your opinion to start investing in any market?
Is this for people that are going to buy a home to live in it, or people that are investing to buy and hold?
Investing, yeah, to hold it or to flip it. Like where's the least risky position going forward, at least in the next 18 months?
Well, the least risky position for people that want to buy and hold is, in my opinion, find the 1% deals, if you can. Um, where you buy a property for 200,000 and it can rent out for approximately 1% of its value, 2,000 a month, and they exist. You just have to know where to find them. As far as people that are flipping, um, you know, I would say really buy anything as long as the margins fit and the three principles of flipping are applied, meaning acquisition number, budget, and ARV have to equal the equation that you and I have been working on for many years.
So should people be worried about a continued decline on their ARVs? Uh, in your opinion, is it going to be challenging for people to get these mortgages on these nice houses when they're completed? Like, say someone's flipping or refining properties. Should we be worried about the numbers we're getting today reflecting when we're continuing the project and finished in 6 months?
I don't think so. I mean, it's extraordinarily rare, in Winnipeg for properties to have an underappraisal issue. It happens, but it's extremely rare. If you're flipping, or you're going to do a BRRRR, buy, rent, renovate, and hold, buy, rent, renovate, rent, and hold. Most of these projects are going to be completed in 3 to 6 months. We're probably not going to see a massive, dramatic change in that 3 to 6 month period. So if I give somebody an ARV, I'm going to be as accurate as I can within the context of that word, but I'm going to be conservative so that in the vast majority of cases, they do achieve that number, either through when they sell it or when they call their lender to say, my property's finished, I want to refi.
Yeah. So, I mean, Winnipeg, solid market. The Prairies, relatively solid. Alberta, relatively solid. As long as you're staying out of vanity markets, you should be all right. Um, there's money to be made in vanity markets as it fluctuates
Sure.
as speculation. But if you're looking for wealth and things like that, it's not the flashy markets that are going to be providing you wealth. It's going to be, like you said earlier, boring markets. And if someone was in Ontario and they wanted to invest, say, in Winnipeg, or they're in BC and they wanted to invest in Winnipeg, what would be some advice that you would give someone thinking about investing outside of their market?
Well, number one is I would invest in training to make sure that I have the best training possible to understand how the process works, how to raise capital so you don't have to use your own money, because that's a big skill in itself. And then I would build a team. I'd find somebody who could be my coach to coach me through this. I'd find a good lawyer who's familiar with these things. I'd for sure find a good realtor who's worked in this space before and has a track record of doing that, and a money partner. So my two things that I would tell anybody would be to find a good coach, someone to train me and invest, and then build a team.
So we got about 10 minutes left here as Zoom is telling me here. What do you think the real estate market will look like in 5 years?
I think in Winnipeg in particular, it will look strong. As you said earlier, we don't have it's not a one industry town. We have a diverse economy here. We continue to see increased in immigration, which drives demand. Rents continue to go up, so people are always looking for places to rent. Mm-hmm. There's really not much the government is doing in Winnipeg or Manitoba to increase supply, so the supply and demand issues are still going to be there. And yeah, I mean, somebody who buys a property now and holds it, if they bought it this month and held it for the next 5 years, you're probably going to make a lot of money.
So, last question. If you were to raise, say, $10 million tomorrow yourself, what would you invest it in?
I'd probably invest it in maybe half of it in properties that I would like to renovate and flip, and then half of it in rental properties, either single family homes or multifamily or even a small apartment block.
Yeah, because we're going to see, natural inflation of those, all the money that went into the market, the inflation of people's money is driving the price of properties up. I remember when I started in this business, the average market price in Winnipeg was something like 310, and I think based on the market data that I have here, I think the middle of the market in Winnipeg is now something like 450 or 430, something like that.
It's gone up at least $100,000 from what you had previously said. Yes.
And so, nothing special. It's just time. I was talking to a guy off of a marketing mailer yesterday, and he's like, I own a bunch of stuff out in Transcona. I own like half the street. And I'm like, yeah, what year did you buy it in? He's like, oh, I bought them in 87 and 89. And I could have bought this apartment block on Regent Avenue, which is it's like a 20 unit apartment block. He said the lady was selling the building for $250,000. Today, the guy who owns it is asking $4 million for the same property. Now, granted, that was 20, 30 years, but $250,000 down, and you could probably have taken control of that building for far less than the full ask price. But if you raise the money, you got partners, $250,000, let's say today is the 80s and we're looking at that apartment block of $4 million. In 20 years, it's hard to imagine, but the $4,000 car doesn't exist anymore. After the inflation in the 70s and the 80s, that $4,000 brand new car is now $12,000. And today, that car brand new might be $50,000. And so it's not that people have more money, it's that they've cut the money up over and over again with inflationary periods, and we've got just less buying power per dollar. Now, that's kind of crappy with consumer goods, but when you're on the receiving end in real estate, that's really where you're getting this inflation. Now, one question I have is, are you seeing institutional buyers moving into Canadian markets? Are you seeing any sort of like hedge funds or anything like that starting to buy property in Winnipeg, or have you heard about them? Because it's happening in America. They're raising a massive amounts of money. Are you seeing that coming to marketplaces now? Is it happening? Is it already too late? What would you say?
I'd say yes. The institutional investor buyers recognize what's going on in the market, so there's a lot of money flowing into these funds, and they're buying properties, and they're coming to Canada. One thing that I was thinking about when you were talking, and the best analogy I can give to anybody that's listening is, because I like sports analogies, the best baseball hitters talk about waiting for their pitch, being patient and waiting for their pitch. So that's the same thing in the real estate investing world. Is if you were an investor sitting on the sidelines and you were waiting for your pitch, that the timing is now because of the fact that of what we've discussed. Now the pitcher's arm is tired. It's going to be much easier to hit a home run if you're aware of what pitch you're looking for and then swinging when that pitch comes across the plate. So, like we said with the title of this Zoom call, the window of opportunity. This is the window of opportunity. This is when the pitches are there to be swung at because of the timing, because the pitcher's arm is tired.
Yeah, and especially if you think about the analogy in the pro athlete, they spend countless hours being trained and coached and even analyzing the pitcher as the game goes on, and they know that later in the game, in maybe the fourth and fifth inning, this pitcher's arm is going to start to get a little bit tired. The ball is going to be, maybe he's not throwing fancy stuff, and maybe he's getting desperate and he's just trying to pitch out the inning. And now is the opportunity, and all that training, all that preparation, raising the capital, understanding the marketplace, and getting the people to get ready. Because I believe as an investor, you are a high performing athlete of some form, because we are waiting for opportunity. This isn't a hourly income event. This is opportunity is coming, and there's always a way to hit the ball in every inning on every pitch, but really waiting for that opportunity to take that swing, but being ready for that opportunity that is delivered to us, because we're not necessarily in control of the opportunity, but we are in control of which opportunities we take and how ready we are when those opportunities emerge. And I think we are in an opportunistic marketplace here. Any final thoughts for the audience?
Yeah, 100%. I mean, and you know what? It goes back to what you said about who would I call if I found an opportunity. Usually, the investors that I do reach out to have spent a lot of time and energy and funds to get trained, to be ready to recognize opportunities, to have the capital ready to go, or at least to know who to call to raise the capital. But the common thread that runs through all of my investor clients that I work with that have been the most successful is that they have invested time to understand how this whole thing works and what they need to do, and invested money and have been happy doing it because, as I said, their returns have been probably tenfold, if not
Yeah.
more.
Well, you look at the investment in some sort of education, like learning how to raise money, and if you're not knowledgeable, you're going to strike out and you're going to quit. Real estate can take you out the game in one move. You can seriously damage yourself by not knowing what's going on, more than it's going to cost you in your pocket to learn what's going on. One bad move can take you out of the game, and now you're like Stefan Arne used to say, now you're the guy at the grocery store sweeping up the floor saying, I used to invest in real estate and I got wiped out and you shouldn't invest. Well, it's likely because you weren't trained on the intricacies of raising capital, identifying the market, and really being ready, because fear is going to hold you back. But fear is not real. It's just what we don't understand. So the training really comes in to build your confidence, is to understand what is happening and to put those fears away with information, because the information coming from CBC and all the major networks is a national message, but your market that you're in is a local market message that you need to be, really aware. So I got a minute here. I just want to wrap up and say, thanks, David, for DT, for taking the time here. I know you're busy. You got lots of appointments today. And, I'm sure the audience is going to love this. And if you're missing it on the replay, you can watch it then. And if you're looking for more information on how to raise capital, how to take advantage of the marketplace, just message in the comments here, and you can book a call with me. We can talk a little bit more about real estate investing and how you can get started before the window closes. Thank you very much, Dave, and I will talk to you later. Go ahead.
Thank you. Sure.
Thank you. Bye-bye.
Bye.